So continuing on with market structures, and again, I'm kind of go back and forth on a lot of these things, but we are covering chapters 10 through 14. Just to kind of keep that in mind, this is part two, but there's a lot of moving back and forth, if you will, between the different market structures as I go through. So continuing on to monopoly. Monopoly, this is a basic rule of thumb, and the monopoly is the firm is the market and the market is the firm. They are price makers. And monopoly in general, our typical idea of monopoly, think of antitrust, late 19th century into the 20th century with such companies, as Standard Oil, Rockefeller fame, of Andrew Carnegie, U.S. Steel, of Vanderbilt with the railroads and so on and so forth. Those are the typical monopolies, and that was all part of the antitrust legislation that went through. So keep in mind, whenever you hear the word antitrust, trust is the same as monopoly. So if we're talking about antitrust, we're talking about anti-monopoly. So again, monopolies in general in the U.S. Are not legal. They are illegal, but there is a differentiation between the typical monopoly, if you will, and what's called the natural monopoly. We'll get to that in a minute. So again, the firm is the market is the firm. There's one seller. There are no close substitutes. Very high barriers to entry. Those barriers can be of a legal nature, and that's when we'll start talking about natural monopoly. Whenever you hear natural monopoly, think public utility. Other barriers would include economies of scale. Again, very similar to oligopoly. To break into that monopoly status, it's very, very costly. Very, very costly. Not just in terms of financially. It takes a long time to break through monopolies. It's legal battles, etc. So that's in general we're talking. There could also be the exclusive ownership of necessary resources. In this case, we'll think of De Beers. De Beers controlled the diamond markets. They were in South Africa. They controlled the world diamond markets for probably 100 years, meaning that they had a monopoly, and they had a monopoly on the sale of diamonds, the mining of diamonds, the marketing of diamonds, the sale of diamonds, etc. And that is kind of changed in recent memory due to two things. One would be the advent of artificial diamonds. Those are the ones that they're able to reproduce or make diamonds. Putting carbon basically under extreme pressures to form a diamond, as what happens like a cone of a volcano type of an arrangement, where diamonds are actually formed. The other has to do with another diamond find, not just in South Africa. There was a major diamond find of all places, in northern Canada. It was revealed under the ice, so this is under that permafrost, if you will. They discovered major diamond find. I forget the name of it, but anyways, it was in northern Canada, probably, I guess it's probably going on 10, 15 years ago now. Anyhow, so far as pricing is concerned, monopolies are price searchers. They have the ability to control prices, and they control prices in order to raise revenue. Straightforward, just like all other firms. Focus on where the marginal revenue is marginal cost. That's that profit maximization, but they're able to raise prices, through controlling supply. Quite simply, since they are the only player in the market, they're able to control supply however they wish. And again, the last thing here is a natural monopoly. Natural monopoly is what we call utilities. Utilities like electric companies, gas companies, etc. They're natural monopolies, and we actually they're sanctioned by the state, by states specifically, and they're controlled by states. They're controlled pricing and so on and so forth. We'll get into that in a bit more detail going forward, but it is something that the kind of to just kind of summarize what happens is that with if you think about an electrical company, right? Electricity, producing electricity, just think about it in terms of delivering electricity via power lines, right? Or underground cables, what have you. But we'll just say with overhead power lines, if you had multiple companies delivering electricity through overhead power lines, you would have a spaghetti of wires overhead. So anyway, that's just kind of there's more to it than that, but that's just to kind of give you an illustration of one of the problems that are associated with, I shouldn't say one of the problems, one of the rationales, if you will, behind having natural monopolies, where they are controlled directly by states through public utilities commissions, public service commissions. They're the ones that control the pricing, really is what it comes down to. Again, continuing on with monopolies, the dual effects of a price reduction on total revenue. So to sell an additional unit of a good, for example, the monopolist needs to lower price. Remember, you're on the demand curve, and in order to sell more quantity, you have to reduce price. This price reduction can result in either, I should say, both in either gains in revenue and or losses in revenue for the monopolist, depending upon the price elasticity of demand. Straightforward. So the monopolist demand and marginal revenue curve are not the same. That goes without saying, right? So that average revenue curve, since it's not horizontal, it's not perfect competition, and it's downward sloping, and therefore, again, the marginal revenue curve is 1/2 of the average revenue curve or demand curve. So in a monopoly, the firm's demand curve, again, is not the same as its marginal revenue curve. The monopolist demand curve lies above its marginal revenue curve. Just keeping these things in mind. So if a firm maximizes revenue, does it automatically maximize profit too? No. Simple answer. Maximizing revenue is the same as maximizing profits only when a firm has no variable cost. And that's typically not the case, is it? It is unlikely, though, that a firm will be without any variable cost. The monopolist that seeks to maximize profits produces a quantity of output where marginal revenue is equal to marginal cost and charges the highest price per unit at which that quantity of output can be sold. So again, this is that we're back to that same kind of trap, if you will, so far as all market structures, where marginal cost cuts through marginal revenue. That is the point where you're maximizing your profit. Again, the monopolist, again, like any other markets, any other firm, any other type of firms in these market structures, they maximize profit and maximize quantity, if you will, where marginal revenue cuts marginal cost. And again, something to notice, and this is pretty straightforward as well, is that the profit maximizing quantity of output is greater than the marginal cost. So the output is greater, the average revenue, if you will, is greater than the marginal cost. So price is greater than the marginal cost. So here we are, the two extremes. One is perfect competition, the other is monopoly. So in perfect competition, we have price is equal to marginal revenue. They're one and the same. Average revenue or demand is also equal to marginal revenue, and price is equal to marginal cost. It's where marginal cost cuts through that price line, right? And it's also, we note that the consumer surplus is maximized, and regardless of the price that is being charged, the producer surplus is zero. There's no economic rent, there's no producer surplus. All the revenue is under the cost curve. It's all the revenue that flows through to the firm is cost. So the cost is equal to the revenue. And remember, included in that cost is what? Is your opportunity cost. That's what we're really saying. And included in that opportunity cost is profit, normal profit, a small profit, an opportunity cost level of profit, where you're the productive resources are earning just enough to cover their costs, just enough to keep going back to work in the morning. That's what opportunity cost is, right? You're receiving enough pay to justify you going back to work the next day, and no more, no less. Whereas a monopoly, we just described perfect competition. Monopoly is not perfect competition. Price is greater than marginal revenue. Average revenue or demand is greater than marginal revenue, and price is greater than the marginal cost, as we noted in the previous slide. And the consumer surplus is less than where it ought to be. The producer surplus, on the other hand, is much greater than it ought to be, if you will. So the case against monopoly is pretty straightforward. There's a deadweight loss that's associated with not producing as much as should be produced. The rent seeking is the effort by a firm to expropriate that consumer surplus. They're getting more than than the consumer surplus. They're getting more than their just desserts. They're receiving more. They're receiving more than their opportunity cost level of compensation. And at the root case for this is a failure to achieve equity and efficiency. So it absolutely violates that theoretical welfare economics idea, where we're trying to trying to achieve equity and efficiency. So the productive resources are earning more than their opportunity cost level of compensation. And the price, the goods and services are priced higher than where they ought to be, and there's not as much being produced as there ought to be on the efficiency side. So walking through, again, the case for perfect competition, we're saying with perfect competition, price is equal to marginal revenue, and average revenue or demand curve is equal to marginal revenue. So once again, we're looking at, I wanted to kind of illustrate this when we're talking about moving from perfect competition now to monopoly, for example. So with our representation of perfect competition, again, on the left, we've got the market, which looks like a typical supply and demand curve. And on the right, we have the individual firm and the cost that it's facing, and so on and so forth. So again, this case C, if you will, perfect competition, we're saying price is equal to marginal revenue on the right, and average revenue or demand is equal to marginal revenue. So they are one and the same. Marginal revenue and average revenue, or the price line or the demand curve, if you will, are all the same. They're all one and the same. And also, where price is equal to marginal cost, this is where they're actually producing. So that one point where all of these come together. When we're talking about price, marginal revenue, marginal cost, and marginal cost, of course, goes up through the bottom of average cost. So this is, again, where we're talking perfect competition as opposed to monopoly. On the right-hand side, price is greater than marginal revenue. That's pretty straightforward. The price is above the marginal revenue. The average revenue or the demand curve is also greater than marginal revenue. Again, straightforward, typical downward sloping demand curve. And price is greater than marginal cost, similar. And there's a loss of consumer surplus as a result. Okay, so again, just showing the bookends, if you will, of market structures, moving from perfect competition out through to monopoly. So here's our walking through, if you will, the rationale, if you will, for monopoly. And I have monopoly on the top, but let's start first with perfect competition, moving across in terms of case A. Okay, I've got it flipped upside down, but at any rate, we'll start with A. Case A, perfect competition. So that's the column, case A, perfect competition, 1 million units demanded by the market. The number of firms in the market are 10,000. Output where minimum average cost is reached is 100. So this is, again, the column is case A, moving downward, and then along the left-hand side, the rows, market type, units demanded by the market, firms in the market, output where minimum average cost is reached. Case B would be an oligopoly. Again, we're just talking about 1 million units demanded by the market in toto. The number of firms in the market are 5. And the output where minimum average cost is reached is 200,000 units. Okay. And lastly, and this is the case where we explain why it is that we have monopolies, why we allow natural monopolies, why we allow public utilities, why we allow just one in a given area. We give them a license, in essence, to be a monopoly for whatever that service or good that they're providing. Public utility, right? Providing electricity. So the number of units demanded by the market are 1 million again, 1 million of whatever we're talking about. The number of firms in the market is 1. And the output where the minimum average cost is reached in units is actually 1.2 million. So the reality is that even with one firm, you cannot reach that minimum average cost with the when the market just demands 1 million units. So what that means is that you're going to allow the monopoly to price to sell at a higher level than otherwise would be the case. So again, it's above where the output would be the minimum average cost in units, and also not just the units, but the associated prices with those number of units. So again, at any rate, just walking through the KC rationale for monopoly, natural monopoly, even with one producer, the market cannot achieve that minimum average cost. This is the key takeaway. The others are things that we've already covered, but oligopoly regulatory authorities are in place to prevent oligopolies from moving toward that monopoly status. So that's the FTC or the Federal Trade Commission, the Department of Justice, DOJ, Antitrust Division, enforcing that consumer sovereignty. And again, moving back to A, in perfectly competitive market structure like case A, competition is allowed to influence price behavior consistent with the common good, the common weal, right? The overall for societal, as society would like it to be. This is the case where economic behavior in the market comes closest to the theoretical welfare conditions of equity and efficiency. I'm saying this over and again because it is so important. And it's required in order to gain that consumer sovereignty, where consumer reigns supreme over these markets, right? As more sectors of the economy move toward this type of market structure, toward perfect competition, prices become increasingly market determined and flexible downward when surpluses occur. Firms lose price power as they face increasing competition, as the market in which they operate become more competitive. As the markets become more competitive, the biases toward inflation and recession, so characteristic of the economy 30, 40, 50, 60 years ago, begins to decrease as firms lose their price power. Having said this, we've been seeing an increase in market power as people are very familiar with a lot of the high tech. When you hear things like FANG, Facebook, Apple, Netflix, and Google, and other firms like Microsoft, etc., they have gained an incredible amount of market power over the course of the last 10, 15 years. So much so that they constitute a huge portion of the market. And we'll talk more about that as we go along, but I just wanted to point that out. So when we talk about measuring market power, it's actually pretty straightforward. And this is something that, again, the Department of Justice, Antitrust Division, the Federal Trade Commission, they do focus on these things. They use these as metrics to try to determine where market power actually resides. And the easiest one, there are several out there, but the Herfindahl-Hirschman Index, I always get that backward. The HHI, or the Herfindahl-Hirschman Index, or the sum of the squares. It's very straightforward. So just as on a scale, it's 0 to 1,000, highly competitive, 1,000 to 1,800, moderately competitive. So we're moving closer to what? Closer to monopoly, the higher the number. 1,800 plus is highly concentrated. So definitely oligopoly land, moving toward monopoly. So the way it works is that we're saying in the breakout down below, the percent of the market. So it's the breakout, the percentage of market share, if you will. would be 30, 30, that gets to 60, another 20, and that's 80, and the final 20 gets us to 100% market share. So we're saying 30 times 30 is 900, 30 times 30 again is 900. So we're summing up the squares. 400 for a total of 2,600, which gets us where? Into the highly concentrated area. And you can tell that just by the small number of firms that we're talking about. We're only looking at 4. So we're definitely well into oligopoly land, moving toward monopoly with that. So this is a very useful tool. And I have some more examples that are on here as well. But anyway, the takeaway is that these are used, these are actually tools that are employed by the Department of Justice, or at least should be, Antitrust Division in particular, and also the Federal Trade Commission. So when we're talking about, whenever you hear the term merger, or if you hear acquisition, mergers and acquisitions, whenever you hear those terms, a merger, acquisition is someone's acquiring another firm. A merger is two firms coming together. They're the same thing. A merger is an acquisition is an acquisition. It's all the same thing. And what I mean by that is that it has the same intent. And the intent, of course, is to do what? To increase market power, to increase market share. Whenever you see firms moving together, consolidating, it's all about increasing market share, concentrating that market share. So the different types of mergers or acquisitions, I guess I should say as well. Vertical mergers would include something like CVS bought Aetna, and I think more recently, I think Walmart bought Humana. I forget, but anyhow, different. So you're buying. When I say vertical mergers, we're moving from the pharmaceutical company with CVS drugstores and Aetna with the health insurance company. So you're stringing these together, the different components. And vertical merger in terms of ExxonMobil, what you would typically think about that as being, no, that wouldn't be a vertical merger. That would be similar companies, correct? Yes, that is true. So that would be probably more along the lines of a horizontal merger. But nonetheless, what happened with Exxon and Mobil when they merged, Exxon was more of a focused on crude oil production, meaning pulling it out of the ground. Mobil was more focused on retail gas stations, etc. But anyway, you get the idea. It's moving down that pipeline, if you will, quite literally when we're talking about energy companies like Exxon and Mobil. So moving from the crude oil production down to the refinery, down to ultimately to the gas station. So when you merge those together, all of those components, that's a vertical merger, taking it from its production point all the way through to the consumer. Very dangerous. This is the one that gets a lot of scrutiny when we start talking about vertical mergers. Horizontal mergers, that would be similar companies kind of merging together, HP and Compaq, Dow Chemical and DuPont. I think that's pretty much a done deal. I think DuPont ended up taking over Dow, but I'm not quite sure about that. Conglomerate mergers would be, these companies that are just, their tentacles are everywhere and they merge together. So conglomerate merger would be Disney and ABC, for example. Disney being in entertainment, but with amusement parks, etc. And then ABC being more telecommunications, and merging those two together, the conglomerate. Think in the old days it would be GE, General Electric. Facebook and Instagram, certainly along the same lines as well, being conglomerates. So remember when we said about trust, antitrust. Trust is monopoly, monopoly is trust. So antitrust is anti-monopoly. So what happened was, and we talked about the mergers in energy, this goes back a number of years now, 20 plus years, 25 years, if you will, goes well back into before the turn of the century. Anyway, so BP and Amoco merged with Arco, and that would have been in 2000. Shell and Pennzoil and Quaker State, those are like oil companies in terms of like oil that goes into your car. The Pennzoil and Quaker State piece, and of course Shell is a gas. More, it's across the board, but we think more of in terms of gasoline, diesel, fuel, etc. And that was in 2002. Chevron and Texaco was in 2001. Conoco and Phillips in 2002. Exxon and Mobil in 2000. And the oldest one, I guess, would be Marathon and Ashland coming together in 1998. And the reason that they did this, at least on the surface, was they were pleading broke, that they were going out of business. They were just not making enough profit. So in order to make profit, they turned to merging and acquiring and so on and so forth. And as a result of which, rather than having a dozen major oil energy producing companies, we ended up with half that number, 6, 7, rather than a dozen or more. So the result of which, of course, is you get concentration of market. And what is the reason we want concentration of market power? So that we can do what? We can control prices a little easier, if you will. So anyhow, the antitrust regulation, this is a little bit of background. NLRB, the NLRB is what's outcome is, but it was the National Labor Relations Act, and it's also the Wagner Act, which was in 1935 during the Great Depression. Davis-Bacon has also points to the prevailing wage. Prevailing wage looks at, like, basically what we're saying is that what is the union wage for a given area, and if the union wage is typically higher, that would be considered the prevailing wage. That's the wage that government would pay for for services, for building roads and so on and so forth. So you would be getting union wages. Encouraging further unionization is really what it came down to. Antitrust exemption, Major League Baseball, basically it went to the Supreme Court and they declared that it was not interstate commerce. Major League Baseball. Interesting, isn't it? It doesn't make any sense, but that was the reality. So as a result of which, we end up with monopolies in geographically speaking. So you've got the Detroit Tigers, and the nearest competition would be, for example, like it would be Cleveland or Chicago, that type of a scenario. And it wasn't just baseball, it was also football, basketball, and hockey, and the result of which is why we have multi-million-dollar contracts, hundreds of millions of dollars in many cases. Anyway, fixing farm prices. So we're looking at the roots of all these things and trying to rein things in and kind of control the way that markets function and operate. Fixing farm prices or subsidies. There are all kinds of different farm boards, like milk boards, egg boards. And the last one we have here is the Texas Railroad Commission. So most states have many different boards. Canada is even more. It's amazing how many there are in Canada. But even like, for example, in Michigan, we've got the sweet cherry board. I forget what it's called, which would be focusing on. It's all about fixing prices, milk prices, the milk board, egg board prices. Texas Railroad Commission, that was very, very important, very big deal, because they control the price of oil being shipped out of Texas. And I think it went beyond just oil, it was probably a refined product as well, but regardless, that was the Texas Railroad Commission. Tremendous amount of power. Smoot-Hawley, that was a tariff that was implemented in 1930, right at the dawn of the Great Depression. So think about it this way. We had the stock market collapse, followed by the implementation of many tariffs, Smoot-Hawley tariffs. These were tariffs that were aimed primarily, not just at Canada, but having a lot to do with Canada. And so, of course, what did Canada do? Canada countered with their tariffs of their own. It was just, again, it was across the board. So it really put a dent, did some major, major damage so far as international trade. It made the Depression worse than it was otherwise, okay? After World War II, we had GATT, General Agreement on Trade and Tariffs, and that was trying to get the world back up and running again, trying to put some rationale behind, trying to reduce the amount of tariffs and increase trade as a result, right? IMF is the International Monetary fund, and that was there was the IMF Bretton Woods treaty, which again was after World War II, and it was basically saying, putting U.S. as the kind of the world currency, if you will. We were it was through us, through the U.S. system, to try to. So the trade side was GATT, and the money side, if you will, the banking side, had more to do with the finance side, would be the International Monetary Fund. And the objective was to increase trade and to reduce tariffs on the GATT side, of course, but to increase trade, increase the financial flows, make them flow more smoothly. Other regulatory authorities, if you will, be the EPA, Environmental Protection Agency, OSHA, which is, of course, the workplace, I forget. Anyways, it's OSHA has to do with workplace safety, NTSB, National Traffic Safety Board. That has to do with airlines and other dealing with other transportation issues. All these regulatory bodies ultimately result in higher cost faced by these firms and the compliance cost. And so this adds additional cost. More recently, I should say, there was a 7% tariff placed on softwoods coming from Canada, fir and spruce. And that was to help prop up the U.S. Production of softwoods, namely yellow pine, coming primarily from the south. Further, we're kind of stepping beyond, of course, just when we're talking about market structures, but it does have a lot to do with it nonetheless. And this, for example, is why this kind of goes along the lines of OPEC. We're seeing a lot of similar activities coming from the likes of China in particular. So China has become a major player, obviously, especially when we talk about the minerals, okay, and not just in the areas that we're talking about, but it goes well beyond this. But in any case, so here's an example of iron ore, where there's a lot of production in iron ore coming out of Australia, Brazil, China. U.S. is way down. So this is Australia is just an absolutely wealthy in terms of mineral resources. And Australia, of course, feeds a lot of its iron ore goes to China, which we'll see in a moment. Brazil is also a major player so far as iron ore is concerned, and China is as well. So these are just of course the iron ore goes into the production of steel. And the good thing, so far as the actual percentages are concerned, China is just overwhelming so far as steel production is concerned. So they're getting a lot of that iron ore coming from Australia, for example, and also domestically from China as well, and producing lots and lots of steel. Just unbelievable amounts of steel, in fact. Probably, well, you can see it's more than the rest of the world combined is really what it comes down to. So 2019, the steel production, the takeaway from this was, I was trying to make the point, is that there were tariffs that were put in place on a lot of these Chinese goods, and including steel and aluminum, which we'll get to in a bit. But the rationale behind this, of course, with these tariffs, typically tariffs, they can be counterproductive because it drives up the prices for domestic as well as those being imported. But the agenda behind the Chinese producing steel, in part, it's because of their own infrastructure. In fact, I think that over 100%, meaning that they're actually importing more steel as well. All the steel is being used for its own infrastructure, but that may not be the case any longer. Reason being is that China is just absolutely overwhelming so far as steel production is concerned, and the rest of the world is becoming dependent upon Chinese steel. And that could be a dangerous thing, could it not? What I meant by that is it dangerous in terms of the strategic resource for steel. You don't, It's not just steel, not just iron ore, not just bauxite, not just aluminum, many other things as well. So this is kind of some of the rationale behind it. So anyway, this is just another example. We talk about bauxite. That's basically the ore that aluminum is produced from, right? So the takeaway is that with the bauxite, is that the major producers are no surprise, Australia and China, well, Brazil as well, of course, but remember all this this bauxite is going, most of it's not for Australia, most of it's actually going to China, right? So we'll see that in just a moment. So tariffs once again were placed on aluminum products that were coming into the U.S. and coming from China. And China, of course, is by far the largest producer of aluminum. So they're taking that bauxite from Australia and they're turning it into aluminum in China. And you can see that even though Australia is actually I'm not going to say one of the larger producers, but it's larger than the U.S., for example. Most of that bauxite that is produced and that is taken out of the ground, mined in Australia, most of that ends up in China, okay? So these are all things to keep in mind. So this doesn't, while you wouldn't necessarily think about this in terms of market structures, do keep in mind that it's very similar to what we've experienced in terms of like OPEC, which these are in effect, then China has become a cartel unto itself. And they want to control prices, they want to control the world prices. So if they want to put the squeeze on a country that might be under pricing them, China can come in and do what? Lowball them. So they can even reduce the price until they've got no other choice than to drive up the prices back to that world price of oil, excuse me, in this case, iron or steel, steel or aluminum. And this is the rationale behind the tariffs that are placed on the incoming products from China, in this case, again, aluminum, but also with steel. So the centerpiece of market structures, when we talk about market structures, I can't emphasize this enough. We want to focus on this theoretical welfare economics, on efficiency and equity. And it's all of this is really driven by what? Competition, 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 competition. So on the efficiency side, where price is equal to marginal cost and average cost is at a minimum. The efficiency means that the per capita standard of living, so the per person standard of living is maximized, is the best it can be given the current stock of resources, technology, etc. So all else equal, the consumer is getting the maximum number of goods and services at the lowest possible price. So the equity side means that the consumer surplus is at a maximum, subject to the constraint that all productive resources are receiving a reward or income just equal to their opportunity cost. No more, no less. There is no economic rent. Some economists would say that there is no producer surplus. Again, the takeaway with the equity side is that you're receiving just the opportunity cost level of compensation for the use of your productive resources. No more, no less. So how does this impact that income distribution? This is all important. So equity is defined above. Egalitarianism or equality means in one form or another that all resources income should be the same. Unless all opportunity costs are the same, and they are not, chaos will occur in the resource markets where supply and demand for resources will be ignored. For example, you're going to school. What is your expectation for going to school? What is going to be your reward for going to school? A better job than what you would otherwise have, meaning more pay than you would otherwise have if you didn't go to school. So resource allocation will be far less than optimal in general, and the per capita standard of living will fall far short of its potential. Most will be poor, so few can earn more than they produce for society. So again, this is the objective being equality, and the reality is you end up with anything but equality, right? Anything near equality. You can have everybody earning the same amount of income, but is that fair? Is that just? This is the question. So the maximization of the consumer surplus attempts to charge prices above the level where some of all the resources can be paid more than their opportunity cost, and hence the consumer surplus is less than maximized, will undercut either existing competition, will it be undercut by either existing competition or by the entry of new firms, meaning that that invisible hand of competition comes into play. So if productive resources are earning more than they really ought to be, or if the prices charged are more than they ought to be, then that competition, that invisible hand, will come in and level those markets, right? So this is the path to efficiency and equity, by entry and exit, which tends to be relatively easy, like fast food franchises or fruit and vegetable markets, certain types of farms, etc. This is again, the takeaway is that the ease of entry and ease of exit is absolutely critical to this, okay? So perfect competition, one more time. I know I beat you over the head with this, but it's something absolutely imperative to understand. And that is that when we talk about perfect competition, household, as owners of productive resources, you are not getting more than your opportunity cost level of compensation, right? Does not make you happy. You want to earn more. But the reality is that when you have perfect competition, the prices are lower on the other end. So you as consumer are receiving the maximum number of goods and services. That is to say, when efficiency is achieved, the per capita standard of living is maximized. Again, consumers are paying a price equal to the marginal opportunity cost of producing the last unit. Average opportunity costs cannot be lower. They are at a minimum. Also, back to that productive resource, the equity is also achieved because the households are receiving the greatest possible consumer surplus. It is maximized, subject to the constraint that all productive resources are receiving income equal to their opportunity cost, no more, no less. So meaning that everybody is going to be compensated for the use of their productive resources. They won't be overcompensated, but they will be compensated justly, meaning in a competitive market sense. They will be receiving their just desserts. And that's on the micro side. The macro side, once again, heavy competition to keep prices down, lots of substitutes, and tends to also help markets clear, fewer sticky prices resulting in fewer and less severe downturns, gets rid of the recessions, or at least minimizes the impact of those recessions.